You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and for today's episode, I'm flying solo, and I wanted to take some time to highlight some of the strategies that I'll be discussing during my two upcoming OIC webinar events in September. We're going to be shifting gears and moving away from our summer of spreads, in which we covered vertical spreads, calendars, diagonals from every which way, and moving towards some of the more intermediate spread strategies, namely straddles and strangles. And as our time today is short, let's go ahead and jump right into it. Whenever I talk about straddles and strangles, I like to begin with an illustration. So imagine that an investor is standing at a crossroads and unsure of which path the market might take. The path on the left potentially profits as markets fall, and the one on the right potentially profits as markets rally. If the investor has a bearish bias, meaning an anticipation for declining share prices, they might look to buy a put to capitalize potentially on their forecast of falling prices. If they were bullish and forecasted increasing prices, they might look to buy a call. But what if the investor isn't sure which way the market was going to move, only that it will move one way or another? That's where the long straddle comes in. A long straddle is an option strategy in which the trader purchases both a call and a put of the same strike in same expiration period. The main principle of the long straddle is that it puts the investor in place to potentially profit off of big moves either up or down in the underlying stock and or big increases and changes in implied volatility, which we'll get to shortly. And since we're buying both options, the maximum risk is limited to the total premium paid, while the potential profits are significant on the downside and virtually unlimited on the upside. So let's look at an example. Let's assume that a company is about to release quarterly earnings, for example, or is maybe expecting an important court ruling in the next quarter, the outcome of which will either be very good news or very bad news for the underlying stock. So if the news is good, share prices might rally, and therefore the straddle position benefits from that long call option. If the news is bad, shares might fall, and the position benefits from the long put option. In either case, the investor is positioned to potentially profit from market movement without being beholden to specific direction. Again, that crossroads that I had spoken of. Obviously, this ability to potentially profit irrespective of direction comes at a cost, namely the premium paid for the two long options versus the usual single leg or a long contract offset by the sale of a short, as is found in many of our spread strategies. Additionally, as straddles typically look for the stock to move away from the current price, straddle buyers typically buy the at-the-money call and put, which might get expensive, especially if implied volatility is already at an inflated level. Remember that in order to profit from any buying strategy, the position's value must be greater than the price originally paid. So if the XYZ $100 straddle comes in at a cost of $8 per contract, either the long call or the long put must be worth more than $8 at expiration in order for the investor to realize a profit. This would occur with closing expiration share prices of less than $92 or more than $108. So less than $92 or more than $108. Those would be our break-even points. Stock prices outside this range would theoretically result in profit, whereas should share prices fail to break out beyond this range, the investor would likely experience a loss on the trade. And because the position is comprised of two long options, the impact of changes in implied volatility and changes in time until expiration is amplified. If implied volatility levels increase into earnings, for example, it's likely that both options will benefit from increasing share prices. Conversely, as time decay is the bane of option buyers, as we say, they will be doubly affected by decreasing option values as each day passes on these factors in order to realize a profit. I should note that many investors see straddles and strangles as trading events, meaning strategies designed to potentially profit from specific events in time. Again, earnings releases, drug trial results, etc. And the investors often close the trade once that event has occurred. And these types of trades are often known as event trades or event-driven option strategies. Regardless of the timing, the ending value of the position must be greater than the original premium paid for that investor to see profits. The cousin to the long straddle is the long strangle. And like the straddle, the long strangle consists of both a long call and a long put of the same expiration. Where the two strategies diverge, however, is in strike selection. You remember the straddle is typically comprised of long calls and long puts of the same strike, typically the at-the-money strike, whereas the strangle is made up of different strikes for calls and puts. Strangles also typically use out-of-the-money strikes, which means that the underlying stock will need to make an even greater move up or down for the investor to profit, as evidenced by the wider break-even points. Out-of-the-money strikes also are less expensive than at-the-money, and therefore long strangle buyers have less capital at risk than investors purchasing straddles. But aside from that, the mechanics between the two are the same. Maximum profit for the long strangle remains unlimited to the upside due to the long call option, and significant on the downside from the long put strike all the way down to zero, in fact. And similar to the straddle, the strangle can benefit from increases in implied volatility, but is also vulnerable to the constant forces of time decay. Now I want to flip the script and look at straddles and strangles from the seller's perspective rather than the buyer's. Remember our early example where the long straddle came in at a price of $8 on a $100 stock? Some traders might interpret that as the market calling for an 8% move after earnings are released, or the court ruling is announced, or whatever the event is, concludes. Therefore, anyone buying the straddle is speculating that the move will be greater than the 8% forecasted. But what of the investor who may feel that the event is overhyped and therefore forecasting a move less than 8% or even no move at all? Remember that when selling calls and puts, the investor can profit not only by a move one way or another, but can also potentially profit from neutral or range-bound markets, which is what straddle sellers often find ideal. This strategy is kind of like walking on a tightrope, where you're taking a neutral stance and anticipating that the underlying asset price will remain within a specific range, though preferably right at that strike price. Any deviation of the stock on either side of the strike price will likely result in mounting losses for the seller, as with a short straddle, you sell both a call and a put option of the same strike and that same expiration. Short straddles offer the advantage of generating income from the premiums received, but they also come with significant risks. A sharp price movement in either direction can result in substantial losses, making it a balancing act that requires careful monitoring and risk management. Back to our early example, if shares close outside of the range of $92 and $108, the straddle seller is at significant risk, all the way down to zero on the downside, resulting from the short put, and unlimited on the upside, resulting from that short call. If shares finished exactly at that short strike price of 100, both call and put options would expire worthless, and the investor retains that full $8 premium collected, assuming both options are unassigned. If share prices finish on either side of that $100 strike, either the call or the put would be expected to expire with some intrinsic value and therefore would reduce potential profits. Let's say stock closes at 105 on expiration. In this case, the short put would be expected to expire without value, and the investor would likely be assigned on the short call, which would expire with $5 worth of intrinsic value and reducing the investor's overall profit from a maximum of 8 down to 3. If the investor were looking to cast a wider net and potentially increase the probability of their trade resulting in a profit, they might look to widen the strikes from a short straddle into a short strangle. Maybe rather than selling the at-the-money $100 straddle for $8, they instead sell the 95-105 strangle for $5, giving us break-even points of $90 and $110, which are $2 wider on both the upside and downside than that of the straddle, and therefore increasing the probability of success for that seller. In other words, rather than walking on a tightrope and having a need for shares to finish exactly at that strike to achieve maximum profit, the writer of a short strangle is more akin to walking on a 1-foot wide beam. The risk of falling still exists, but it's diminished due to the wider pathway. However, increased success often stems from decreased profits, as the max profit for the strangle seller is now $5 versus $8 for the straddle seller. As to changes in implied volatility and time to expiration, short straddles and strangles are impacted opposite of their long counterparts. Increasing implied volatility often leads to higher option prices, which therefore negatively impacts option writers. But remember that time decay is a friend to option sellers, and doubly so with short straddles and strangles. If share prices remain relatively stable, option prices will erode day by day until the contracts expire, which is an ideal outcome for sellers of straddles and strangles. And lastly, if short straddles and strangles involve selling options, assignment risk is always present. And it's a crucial aspect of selling that investors need to be aware of. It arises when the short options are exercised by the option holder and results in the trader being forced to fulfill their obligations. If underlying prices rise significantly above the strike price of the short call option, the call holder may choose to exercise. And the call writer in this case will be obligated to sell the underlying shares at the strike price regardless of the current market price, potentially resulting in significant losses. If the writer did not own shares to deliver, they may need to enter into a short stock position along with any risk and fees that may go hand in hand with short stock. Conversely, if the underlying price falls significantly below the strike price, the put holder may decide to exercise, obligating the writer to buy stock, again, irrespective of the prevailing market price. However, as exercise and assignment typically occur when the contract expires, and seeing as how straddles and strangles are often employed as event-driven trades, as I mentioned earlier, it is possible and maybe even likely that the seller closes out the short position through a buy-to-close order once the event concludes. If this occurs prior to expiration and prior to a holder exercising, the seller can then relieve themselves of the obligation to buy or sell stock as they no longer have an assignable position. And that's going to do it for this segment on straddles and strangles. But before I sign off, I wanted to continue our recent practice in our podcast of getting to know your OIC instructors. And since I'm the only one in the studio today, I thought I'd take a few minutes to better introduce myself. I got my start in options back in 1997, beginning as a clerk on the floor of the Chicago Board Options Exchange, now better known as SIBO. I was fortunate enough to enjoy almost an 18-year career on the floor, with most of my time spent filling orders in various index products and moving through the ranks until I became my team's lead broker in the NASDAQ and Russell trading pits for the better part of the decade, really. In June of 2015, I made the decision to leave the floor for a variety of reasons, not the least of which was the imbalance I found myself in when it came to stress versus being paid to accept that stress. Since high school, I had always had an interest in teaching and thought that that might be a path worth exploring. So after taking the summer off to spend time traveling and hanging out with my then preteen daughters, I began the process of laying the groundwork for my teaching certificate while still applying for options-related positions away from the trading floor. Happily, I landed at OCC and was able to carve out my own niche, capitalizing on my background and experience in finance with my love of teaching. OCC allows me the bandwidth and opportunity to create my own projects, from revamping our webinar program to creating an all-new curriculum of online courses with our OCC learning platform, and now hosting OIC's Wide World of Options. I'm a lucky man, both professionally and personally, for so many reasons, not the least of which is that I get to talk about options all day and hopefully help listeners like you better understand options on a more personal level. There's one thing that I love above all else, aside from my wife and family, and that's live music. I've been playing drums since I was 13 and attend concerts as often as I can. In fact, I've got 3 shows lined up for next week alone. So that's me, Mark Benzaquen, options instructor, content creator, family man, and concert junkie. And that's going to be all of our time for today. So a big thank you to all of our listeners and supporters out there. For more on buying and selling straddles and strangles, be sure to register for my 2 upcoming OIC webinar events in September, which will include more in-depth discussions, examples, and easy-to-follow slides designed to enhance your understanding of options. Listeners can register for our webinars via the events section of our OIC website, optionseducation.org. And as always, please feel free to send your questions via email at options@theocc.com or live chat with us at our website. Thanks again to all those listening, and we'll be talking with you again very soon. Take care, everyone, and happy trading.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com. or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.